Welcome to Study Session 10, Standard Costing and Variance Analysis. Introduction. This lecture examines analysis between set standard and actual results. It covers the basic variances associated with labor, material, variable overheads, and fixed overheads. Objectives. At the end of this lecture, you should be able to calculate both price and quantity variances associated with materials, labor, and overheads. Standard costing and budgetary control. Controlling costs by making use of budgets is known as budgetary control. Budgetary control is the management process of using budgets to monitor and control the performance of the organization. This is done by comparing the planned values in the budget with actual results as they occur during the year. Budgetary control is a system of planning and controlling costs which involves the following steps. Establishment of budgets. Functional budgets are prepared based on responsibilities of individuals. These budgets are then coordinated to prepare budgeted profit and loss account and budgeted balance sheet. Measurement of actual performance. Comparison of actual performance with budgeted performance to develop variances. Analysis of causes of variance and reporting for immediate action. Standard costing involves comparing actual costs with predetermined costs and analyzing the difference, known as variances. Advantages of standard costing. and equipment, and bad or improper maintenance leading to breakdown and more usage of materials. Yield from materials in excess of or less than that provided as the standard yield. Faulty materials processing. Accounting errors, for example, when materials returned from shop or transferred from one job to another are not properly accounted for. Inaccurate standards. Change in composition of a mixture of materials for a specified output. The breakdown of the material cost variance is shown below. Labor variances. Direct labor total variance (DLTV) or direct labor cost variance (DLCV). This is the difference between the standard cost of labor specified for the output achieved and the actual cost of direct labor used. It is said to be favorable when standard cost is more than actual cost and adverse when actual cost exceeds standard costs. Direct labor total variance is further divided into labor efficiency variance and labor rate variance. That is, DLCV is equals to labor efficiency variance plus labor rate variance. Direct labor rate variance DLRV. This is the portion of labor cost variance that is due to the difference between the standard rate specified for the actual output and the actual rate paid. Labor rate variance is said to be favorable when the actual rate is less than the standard rate and adverse when the actual rate is more than the standard rate. Causes of direct labor rate variance include the following: change in basic wage structure or change in piece work rate, employment of workers of grades and rates of pay different from those specified due to shortage of labor of the proper category or through mistake or due to the retention of surplus labor, payment of guaranteed wages to workers who are unable to earn their normal wages if such guaranteed wages form part of direct labor costs, use of different method of payment, for example, payment of day rates while standards are based on piecework method of remuneration, higher or lower rates paid to casual or temporary workers employed to meet seasonal demands or urgent or specific work, new workers not being allowed full normal wage rates, overtime and night shift in excess or less than the standard or where no provision has been made in their standard. This will be applicable only if overtime and shift differential payments form that laid down in the standard. Direct labor efficiency variance DLEV. This is the portion of the direct labor cost variance which is due to the difference between the standard hours specified for the actual output and the action hours used for the actual output. It is said to be favorable when standard hour is more than actual hour and adverse when actual hour exceeds standard hour. The causes of direct labor efficiency variance include the following: lack of proper supervision or stricter supervision, poor working conditions, defective machine tools and other equipment, basic inefficiency of workers due to low morale, insufficient training, faulty instructions, incorrect scheduling of jobs, and so on. Use of non-standard material requiring more or less operational wages. Carrying out operations not provided for and booking them as direct wages. Incorrect standards. Wrong selection of workers. Increase in labor turnover. In case of idle time variance equals idle time hours times standard rate. When idle time occurs, the efficiency variance is based on hours actually worked, not hours paid for. and an idle time variance, hours of idle time times standard rate per hour, is calculated. Example 1. The following are the abstracts from the standard cost card for part number 1004 and actual results for the month of January. You are required to 1. Calculate material cost variance and its components. 2. Calculate labor cost variance and its components. Variable overhead variance. Variable overhead total variance, VOTV. The difference between the actual variable overheads incurred and the variable overhead absorbed. Variable overhead expenditure variance. The difference between the actual variable overhead incurred and the allowed variable overheads based on actual hours. Variable overhead efficiency variance. The difference between the allowed variable overhead and the absorbed variable overhead. Fixed overhead variance. Fixed overhead total variance. The total difference between the fixed overhead absorbed by the actual production and the actual fixed overhead for the period. Fixed overhead expenditure variance. The difference between actual fixed overhead and allowed or budgeted fixed overhead for the period. Fixed overhead volume variance. The difference between the fixed overhead absorbed by the actual production and budgeted fixed overheads for the period. The volume variance arises from the actual volume of production differing from the planned volume. If required, the volume variance can be subdivided into an efficiency variance and a capacity variance. The fixed overhead volume capacity variance is unlike the other variances in that an excess of actual hours over budgeted hours results in a favorable variance and not an adverse variance as it does when considering labor efficiency, variable overhead efficiency, and fixed overhead volume efficiency. Working more hours than budgeted produces an over-absorption of fixed overheads, which is a favorable variance. Fixed overhead efficiency variance. This is the difference between the standard hour of production achieved and the actual labor hours valued at the fixed overhead absorption rate. Fixed overhead capacity variance. This is the difference between budgeted hours and actual hours valued at the fixed overhead absorption rate. Example 2. Use the data below to compute the basic variable overhead variances and fixed overhead variance. Control ratios. The management wants to know whether performance of its business is going as per estimated schedule or not. This can be identified with the help of control ratios. If the ratios are more than 100%, then the performance will be classified as favorable, but if these ratios are less than 100%, then the performance will be unfavorable or unsatisfactory. Capacity ratio. The ratio indicates how much budgeted hours have been actually utilized. If the ratio is 80%, for example, it means that 80% of the budgeted hours have been utilized and the remaining 20% capacity remain idle. Activity ratio. This ratio shows the level of activity attained during the period. It compares actual level of production with the planned level of production. Efficiency ratio. This ratio shows the level of efficiency attained during a particular period. If this ratio is 130%, then it shows that the efficiency is more by 30% or it has gone up by 30%. Calendar ratio. This ratio shows whether actual working days available are more or less than the budgeted working days. If the ratio is more than 100%, then actual working days are more than the budgeted number of working days, and vice versa if the ratio is less than 100%. When output are produced more quickly than expected because of work motivation, better quality of equipment or material, it leads to favorable labor efficiency variance. Idle time may result from machine breakdown, non-availability of material, or illness. Overhead variances can also be divided into expenditure and volume variances. Other control ratios include activity ratio, efficiency ratio, capacity ratio, and calendar ratio. We have come to the end of ECHO 411. Thank you.